Taxes are often framed as a fair obligation. Everyone contributes so society can function. But when the cost of living rises faster than wages, when interest rates move beyond what households can absorb, the question begins to reverse. In Canada, the combined burden of direct and indirect taxes has grown alongside inflation. While housing prices remain historically high and liquidity in the economy tightens, workers see their after-tax income shrink, small businesses pull back, yet public budgets continue to expand. Where does that tax money actually flow? Who does it protect when shocks from interest rates, exchange rates, and public debt arrive? Credit default swaps once surged before crises elsewhere. Canada still appears stable, but small signals are often ignored: deficit spending sustained by borrowing, a housing market dependent on cheap credit, and confidence maintained by promises. History shows crises rarely begin with a loud collapse. They begin with a prolonged silence, where most continue paying taxes while a few decide how they are used. Warning signs of crisis never appear all at once. They hide in indicators that seem technical and distant. Policy rates rise to contain inflation, but household borrowing costs in Canada surge with every mortgage renewal. High debt-to-income ratios mean even a modest liquidity squeeze can trigger a chain reaction. The housing market, long a pillar of middle-class wealth, slows as transactions fall and prices lose momentum. Meanwhile, persistent deficits push governments to borrow more, raising public debt in a high-rate environment, a dynamic that once pulled Greece into a brutal spiral. Canada's CDs remains low, reflecting market confidence, yet Argentina's. History shows how quickly trust can evaporate when tax revenue can no longer cover spending. These signals are not a crisis, but they are early warnings. When taxes rise while financial security feels weaker, the gap between surface stability and hidden risk quietly widens. To understand why taxes become central during economic shocks, we must look at how public money flows. When growth slows, governments often rely on taxes and debt to sustain spending, compensating for a weakening private sector. Problems arise when efficiency lags behind revenue collection. Higher interest rates increase debt servicing costs, forcing budgets to prioritize interest payments over long-term investment. Liquidity is drawn toward the public sector, while households and small businesses compete with the state for credit. This pattern appeared before Latin American debt crises and was clearly visible in Argentina. High taxes, large spending, but stagnant productivity. Canada is not there, but its reliance on housing and finance makes it highly sensitive to interest rates. When taxes stabilize the short term instead of raising productivity, economic shocks do not disappear, they are merely delayed, and the cost is gradually shifted onto taxpayers. Global economic history reveals familiar patterns. The Asian financial crisis of 1997, under IMF intervention, began with currency imbalances and capital flight. Yet its final burden fell on citizens through higher taxes and social spending cuts. Greece raised taxes to save its budget after 2008, trading fiscal survival for prolonged recession and record unemployment. Turkey sustained growth with cheap credit, only to face inflation and currency collapse, turning indirect taxes into a fiscal lifeline. Venezuela went further. Taxes failed entirely once production collapsed and the currency imploded. The common thread is not tax levels, but who taxes ultimately support during shocks. In every case, the middle class became the shock absorber. Canada differs through stable institutions and a strong currency, but faces the same fundamental choice. Protect the financial system, preserve market confidence, or ease pressure on households. These choices are rarely neutral. In Canada, these mechanisms now shape daily life. Inflation pushes workers into higher nominal tax brackets, even when real purchasing power stagnates. Consumption taxes and service fees expand as local budgets strain. Higher interest rates turn mortgages and credit card debt into psychological and financial burdens. Housing, once a safe store of value, now carries liquidity risk as buyers hesitate. Meanwhile, tax revenue continues to support system stability and ensure large institutions maintain access to credit. The feeling of paying more and receiving less is not abstracted, is lived experience when taxes are used to maintain a fragile equilibrium. The question is no longer whether taxes are necessary, but who is actually being shielded when the economy begins to shake. Government and central bank responses are often framed as technical decisions, yet their effects are deeply distributive. When the Bank of Canada raises rates to fight inflation, the stated goal is price stability, but the cost is borne by households. With variable or renewing mortgages, governments sustain spending to avoid deep recession, which means continued taxation and debt issuance in a high-rate environment. Liquidity is deployed selectively. The banking system and key sectors are protected to prevent systemic risk. This logic mirrors past crises from Greece to IMF-led interventions in 1997. Stabilize the structure first, adjust society afterward. In Canada, this process is softer, but the principle remains. Taxes buy time, preserve market confidence, and diffuse the cost across the population. At its core, the question, who do taxes support, is structural, not moral. In a high-rate environment, those holding flexible financial assets can reposition capital and hedge against inflation or currency risk. Those dependent on fixed incomes cannot. Low CDs levels signal confidence in Canada's ability to repay debt, but that confidence rests on the assumption of stable future tax flows. This creates a loop. To preserve credit ratings, governments must collect reliably. To collect reliably, the burden falls on the workforce. Argentina entered a similar loop before default. Canada is not there, but quiet polarization is emerging. Taxes do more than fund public services. They protect the existing financial order. And within that order, protection is unevenly distributed. In this environment, individual survival strategies become essential. Not everyone can optimize taxes or access complex financial tools, but awareness of liquidity is a starting point. Managing debt flexibility, avoiding reliance on a single income source, and understanding how interest rates affect living costs can soften policy shocks. In countries that experienced crises, Turkey or Venezuela, citizens learned to defend themselves through tangible assets or strong foreign currencies. Canada does not require such extremes, but the lesson remains. Do not assume the system will absorb risk on your behalf. Taxes may stabilize the macroeconomy, but they do not guarantee micro-level security for each household. When the pieces are assembled, the picture is not of imminent collapse, but of a slow redistribution of burden. Taxes help Canada project stability, keep CDs low, and maintain a strong currency, but at the cost of sustained pressure on consumption and middle-class savings. The IMF once described this as stability through risk redistribution, where risk shifts from government balance sheets to household budgets. Greece experienced it brutally. Argentina cyclically, and Canada is approaching it more subtly. No sudden cuts, no currency collapse, just the sense that each year feels harder, even as the economy is labeled safe. In this context, taxes are not merely revenue. They are a mechanism of delay, keeping the system running while deeper structural tensions remain unresolved. At the end of this story, taxes in Canada appear as a double-edged tool. They fund public services, protect the financial system, and preserve confidence in the currency. But they also obscure harder questions about productivity, growth models, and risk distribution. From IMF 1997 to Argentina, Greece, and Turkey, history shows that when taxes are used primarily to buy short-term stability, crisis does not disappear, it changes form. Canada still has choices. Will taxes continue to sustain a fragile balance, or become leverage to invest in productivity and reduce dependence on debt? When you look at your after-tax paycheck, interest payments, and housing costs, the real question is not how much you pay, but in today's economic order, are you being protected or protecting someone else?